Okay, get this. What if you could drive a brand new 20 lakh rupees car for 5 whole years and then, at the end, get all your money back? It sounds totally impossible, right? Well, an online source has laid out this incredible financial hack that claims to do just that. So, in this explainer, we're going to break it down step by step to see how it's even supposed to work.
That is the big question, isn't it? Is this a real, genuine financial loophole, or is there a catch we're not seeing? Let's find out.
We're going to dive right in and follow the logic from the source. We'll look at the exact numbers, the specific tax rules, and everything this entire strategy hinges on.
All right, first things first, let's talk about the setup. This is probably the most critical part. According to the source, if you don't get this foundation right, the whole thing just falls apart.
And here we have it, the single biggest assumption of this entire plan. You have to start with 20 lakhs in ready liquid cash. Without this capital just sitting there, the strategy is a non-starter.
Now, here's where it gets really interesting and a bit counterintuitive. Instead of just buying the car with your cash, the strategy says, no, you leverage debt. You only put down a small chunk, 4 lakhs, and then take a loan for the other 16. And this is the secret sauce. You take the 16 lakhs of your own cash that you didn't spend and you put it into a fixed deposit for 5 years. So you've got these two financial tracks running at the same time. Okay, so let's jump ahead and see how this all plays out over the next 5 years. This is where the real magic, or, the math, really starts to happen. And it's all about playing the tax game.
But before we go any further, there's a quick concept we need to get our heads around. It's called written down value depreciation, or WDV. See, unlike just taking a flat amount off each year, with WDV, you apply the depreciation percentage to the new, lower value of the car every single year. That means the amount you can claim actually goes down over time.
And this is why buying the car in your business's name is so powerful. It unlocks two major tax deductions. First, you've got the depreciation, that loss in the car's value. The source points out that for an EV, this can be a whopping 40%. And second, all the interest you pay on that car loan, that's also a business expense. Just look at these numbers. This table really shows you the power of that 40% depreciation. In the very first year, you get to claim a massive 8 lakh rupees as an expense. And yet, it decreases each year, but you can see how quickly it all adds up. So, over the full 5 years, what are we looking at? The total depreciation you can claim as a business expense is over 18 lakhs. Plus, you've got almost 3.5 lakhs in loan interest. Together, that's a huge reduction in your taxable business income.
So what's the bottom line of all those deductions? What does it actually mean for your wallet? Well, by reducing your taxable income so much, the source calculates a direct tax saving of about 6.6 lakh rupees. That's real cash that stays in your pocket instead of going to the taxman.
Okay, fast forward 5 years, the loan's all paid off, the car has been depreciated way down, and now the strategy calls for a really clever final maneuver to unlock the car's leftover value. So here's the endgame. First, you legally transfer the car from your business to yourself personally. And the price for this transfer? It's not the market value. It's the final book value after all that depreciation, a tiny 1.55 lakhs. Then you immediately turn around and sell that same car on the open market for what it's actually worth, which the source estimates at a cool 10 lakhs.
And this quote right here, this is the linchpin of the whole endgame. That huge profit you just made, the difference between the 10 lakh sale price and the 1.5 lakh transfer price, is completely tax-free. And why? Because a personal car isn't seen as a capital asset like stocks or property, so selling it doesn't trigger any capital gains tax. It's an incredible loophole.
All right, we've seen all the moving parts: the loan, the investment, the tax game, the final sale. Now it's time to put it all together and see the final result. Does this thing actually add up?
So, just to recap, this strategy has created value in 3 different ways. First, we've got the tax savings from the business. Second, that big tax-free profit from selling the car. And third, remember that 16 lakh rupees we stuck in an FD at the very beginning? We now need to count the money it made.
This chart really paints a clear picture of where all the money came from. As you can see, the single biggest piece of the pie, making up almost half the gain, was that clever tax-free resale. The tax savings were also a huge chunk, and the fixed deposit just provided that solid, predictable base. So you add up all 3 of those streams of income, and what do you get? Well, according to the source's calculations, the total financial gain comes out to a staggering 19.6 lakh rupees. And here it is, the moment of truth. You put the total gain of 19.6 lakhs right next to the original 20 lakh cost of the car. I mean, the difference is practically nothing. So the takeaway from the source's math is pretty mind-blowing. The strategy seems to deliver on its almost unbelievable promise. After 5 years of driving a premium car, the combination of tax savings, investment returns, and that clever resale has effectively paid for the entire thing.
So, we've seen how this hack works on paper, and it's a fascinating look at using tax laws and asset management to your advantage. But, of course, its success really rests on some big assumptions, doesn't it? You need that 20 lakhs in cash to begin with, you need a profitable business to claim expenses against, and you're betting on a stable resale market for your car in 5 years. It just goes to show you, the most powerful financial strategies often aren't just about earning money, but about really understanding the rules of the system.